Hi everyone, this video is going to be our lecture video for chapter 1, where we're going to talk about managerial accounting concepts and principles. So in this chapter, a few of the student learning outcomes that we want to achieve. We're going to talk about what is the managerial accounting profession, just kind of give an overview of managerial accounting in general. And then we're going to talk about some specifics related to cost accounting. We're going to define product and period cost, explain how they impact financial statements. We're going to explain some of the differences between manufacturing and merchandising companies from a balance sheet perspective. We're going to look at the manufacturing activities and flow of cost. We're going to compute cost of goods sold for a manufacturer. And finally, we're going to prepare a manufacturing statement and explain its purpose and links to the financial statements. So that's kind of the overall outcome of the entire chapter 1. So some of these things we're going to really accomplish through the completion of in-class exercises, homework exercises, so on and so forth. But in this video, we will dive into the lecture and get an overview here. Okay, so managerial accountants, who we are and what we do. So when we're talking about managerial accounting and managerial accountants, we kind of differentiate that between managerial and financial accounting. So you might be aware of this just because of the fact that you probably took financial accounting immediately preceding or before this class. Now you're taking managerial accounting. So that's kind of a differentiation that we're highlighting here. And there's huge amounts of overlap between these types of accounting. But when we're specifically making a distinction, the financial accounting really is more prepared to be provided to individuals outside of the organization, whereas managerial accounting is more being prepared for the benefit of managers inside the organization. And some of this is financial and some of it's non-financial as well. So it's not just about reporting out financial information like financial accounting is. There can be metrics related to, factory performance or just general goals that an organization has that we want to track as managers. So managers of an organization, other internal decision makers. So for our notes question 1 that asks who uses managerial accounting information, we can say internal users such as managers, executives, and supervisors. Okay, let's look at some of the differences here between financial accounting and managerial accounting. As we've already mentioned, there's more of an external focus with financial accounting, whereas an internal focus with managerial. When it comes to purpose of information, financial accounting being externally provided allows those external parties to potentially make investment decisions, whether they would want to invest in the company, credit decisions, do they want to loan that company money, so on and so forth. Maybe it's a government organization who's providing financial information and some other government organizations reviewing that information to determine whether to continue funding, for that thing or so on and so forth. So any number of different decisions that could be made by external parties influenced by the financial information that business or organization would be externally reporting. Whereas with managerial accounting, really we're trying to use the managerial accounting techniques and reporting processes to better plan and control business decisions, business processes, plan for outcomes, so on and so forth. And I do note this is kind of the table number 2 that's in our notes, so be sure to connect that. As far as flexibility of practice, with financial accounting, we're very much required, typically, if a company is required to follow US GAAP, then those rules are very strict in terms of how you present the financial information, what's included, how it's shown, etc. And a lot of that's what we looked at in accounting 2, financial accounting. Is talking about using certain types of accounting practices, accrual accounting, etc., to have more as standardized external reporting as you can get, because without standardized external reporting, it can be really hard for external parties to really make an assessment of an organization, especially when they compare it to other similar organizations. If each one of those organizations is using a different accounting methodology, then making comparisons between them could be difficult. It'd be like comparing apples to oranges. So with financial accounting, we try to structure everything, try to standardize it. Whereas with managerial accounting, there's not really any U.S. GAAP consideration, relatively flexible. I mean, there are outcomes you're trying to achieve, etc. So, the reports have to make sense and have to be usable, but it's more so about how can we use this data to achieve some sort of outcome that we want. And so we're going to flex our reports around that, goal, essentially. As far as timeliness of information, financial accounting, is more kind of strict in terms of maybe quarterly reporting, annual reporting. We have an audit, maybe if a company is being audited, and a financial statement audit, not an IRS audit. But when we say audit here, we mean a financial statement audit, which is basically like an annual requirement for a lot of businesses to have their financial information analyzed by a public accounting firm to ensure that it is materially accurate, so that outside parties, when they receive that financial information and that external reporting, can have more faith in the information that the company is providing. And then compare that to managerial accounting. We're not waiting for an audit to finish. We're not necessarily relying on a third party or anything like that to finish this work. This, again, is just flexible and performed with the intent to meet some sort of objective. And that can be, done relatively quickly. As far as the time dimension, we're very much looking backwards a lot of the times with financial accounting. We're just trying to report what happened, last month, last quarter, last year, yesterday, whatever it is. We're always kind of looking backwards and reporting that out. And we can take that information, and this is where it kind of crosses over, because historical information, tracking things, reporting it out is, essential. But from a managerial perspective, we're more so going to be forward-looking and trying to make some estimates, make some projections, again, to kind of like set a goal for the future and try to set in place some benchmarks that we could hit along the way to give ourselves confidence that we're moving towards that goal. As far as the focus of information, financial accounting, very much a holistic perspective. You're looking at the entire organization. We have to capture every aspect of the business on the balance sheet, assets equal liabilities plus equity of the entire business operation. And then compare that to managerial accounting. We're more so going to be looking at, individual processes, certain segments of an organization. So again, with that flexibility, it's not that we are necessarily required for any reason to analyze the whole business every time we're doing a project, right? This is more so we have some sort of goal that we're trying to achieve. Maybe that involves one department or two departments or one process or whatever. And so we're only going to focus there because that's what we're doing essentially, right? We're not bound to have to do some sort of analysis of the whole company or anything. This is up to us, managers deciding how to do analyses in a way that is, efficient and achieves the outcome that we're trying to do. And finally, the nature of the information, very much monetary when it comes to financial reporting. Basically we're just using reporting about dollars and value, etc. But there are times with managerial where we could very much be looking at non-monetary information as well. Maybe if we're trying to analyze the process, we might want to know, are we being efficient, in the way that we're using our raw materials, or is our, as far as how much labor is being used to produce a certain product, for example, we might just be analyzing that. not necessarily, I mean, there is financial components to everything basically, so you could sort of convert that eventually to some sort of financial metric or outcome. But we could be analyzing non-monetary information when we're doing managerial accounting at times. Okay, so now we've talked about kind of the differences of in financial versus managerial accounting. And now let's kind of focus in on managerial accounting by itself here as we move into this class further. And let's discuss just briefly here the process of doing this management accounting essentially, and how do we sort of perform that? What are we doing in that process? When we think about financial accounting, you might remember back to the accounting cycle, where you've got the normal journal entries, then there's the adjusting entries, you prepare financial statements, you do closing entries, and you start the whole thing over again essentially, right? So that's kind of the accounting cycle. That doesn't really quite apply the same way from a managerial perspective necessarily. Some processes we have may just be ongoing, regular, processes that recur at a similar frequency, monthly or whatever. But the real idea behind any managerial accounting task that we're doing is developing some goals, some strategic aims, you could say, both long and short term, kind of put that into some sort of annual budget, and then do monitoring, measure things, evaluate things, provide oversight. And after doing that process of the monitoring, then providing feedback back into the planning process, and just having this be an ongoing thing. And as I mentioned, it's not necessarily that it's always different from a frequency perspective, but with US GAAP, it is more consistent typically when you would need to have a set of financial statements that you're reporting out, versus with managerial accounting. That may or may not necessarily align with an annual thing. And some of the process might be annual. Maybe you're making an annual budget, and then some of the other analyses might be more at some different time frequency, or maybe only when those processes occur. Again, it's very flexible and dependent upon what you're trying to accomplish with the managerial accounting you're doing. So as far as number 3 on the notes, what are the major functions performed by managers? You could identify planning, monitoring, and control, and then providing feedback back into this. Basically, these would be the major functions, as we called it in the notes packet. Okie dokie. So let's talk about costs. So these first few chapters in our course are really all revolve around this idea kind of like cost accounting essentially. And when I say cost accounting, I mean analyzing the cost of production for a manufacturing company, organizing those costs, and then using them to determine, to calculate things that we will calculate here as we move forward, like cost of goods manufactured, so that we can understand what's happening in our company and how the costs are flowing through these different manufacturing processes, etc. So just some of the neat, like what kind of questions might arise as a cost accountant or a managerial accountant. You might be analyzing what costs are involved in making a product or providing a service. We have to analyze what are all the costs that we are going to actually aggregate to figure out, what does it cost to make a certain product. We're going to do some work to try and be able to answer the question that if production volume was to increase or decrease, which costs will increase or decrease. We could have the question of something like, what will automation do to our cost structure? Should we make the product ourselves? Should we buy it from a third party, for example? Should we manufacture, or should we just be a merchandiser? Maybe that's another way to say that. And sometimes you could be both, right? Maybe there's parts of a process that you would outsource. If you're an auto manufacturer, maybe you could be making the decision to, make or buy a certain component of the vehicle, and then you still would be the assembler of various parts, but maybe you did not, manufacture every one of those parts, etc. And then how can we control costs? How can we keep costs down most effectively in order to maximize profit, essentially, usually is the goal there. Oh, and let's see. Okay, so our next question too on the notes is all costs are either product or period cost. Define each. So that's going to take us into our next. We haven't answered that one yet, but I'm trying to connect our lecture here to the notes for you as well, so you can pretty easily fill those out as you watch. Okay, so second part of the chapter here, we're going to understand and gain an understanding and control of product costs. So very high level, the way that we want to classify costs for reporting and analysis, you could identify them by these kind of 5 aspects here. So what behavior do those costs have? Are they traceable to a specific product? Are they controllable? Are they relevant? What is their function? So on and so forth. So these are the kind of things when we look at a certain cost that we're going to be basically analyzing. And this is more high level. The thing that really ties into your notes here for question number 4 that asks, all costs are product or period, design each. We're going to talk about those 2 classifications because this is a really good starting point for us to understand what does this even mean, right? So when we're talking about product costs, you can essentially think of any cost that the business incurs that is incurred directly in the production of that product, right? So that would be, well, I guess we'll look at examples here in a few slides, but just to throw some out really quick, obviously the cost of just buying the raw materials, right? Say it's a bakery, you're going to be producing cakes or bread or whatever, and so the cost of buying the flour, that is a direct product cost. And we're going to compare that to things that are period costs. And period costs are things that we would not capitalize, essentially. And when I say capitalize, that means moving that cost into inventory. And maybe I should have said that with product costs. So if we have those raw materials, whatever it is, that's all going to be inventory. We're going to capitalize that, which means we're going to have it as an asset on our balance sheet until the point at which we sell it. So product cost is basically anything that we could incur. It's a piece of that product that we're making. It's going to be an asset until it's sold. And then period costs would just be ongoing cost of operations that are, kind of ancillary to the direct product costs we talked about previously. Period costs would be something like, say like the accounting department salaries, for example, of a manufacturer. So even though those accounting folks are receiving salaries and the companies are incurring costs related to them working for the company, and maybe that company's primary objective is producing some sort of product, because those accountants and that accounting department, for example, is not directly related to that product, in the production of that product, we would be expensing those costs on an ongoing basis. We don't capitalize those accounting salaries as a part of inventory. Those would show up on an income statement as an expense whenever we accrue that expense, right? Or incur it. And so we'll look at a lot of examples and we'll practice that as well. The big high level categories that go into the product cost classification are direct labor. So that would be individuals who are like working on a production line, actually, maybe if you're a baker, the people who are actually doing the baking, so on and so forth. And compare that to like a supervisor in the factory. That would fall under manufacturing overhead, which we'll talk about in a moment. But direct labor is anyone who's directly involved in the production of the product. Direct materials are going to be the kind of things like I mentioned before for a bakery, flour, sugar, salt, so on and so forth, all the actual materials that go into the production of that product. And then manufacturing overhead is kind of everything else that doesn't fit into those 2 categories. And it's things that are more difficult to specifically trace into an individual product. And when I say that, I mean, think of things like factory utilities expense, for example, right? If you're making lots of products, it would be pretty difficult and unwieldy to try and take, the monthly cost of a utility bill and somehow actually be able to exactly tie that cost for the entire month into the production of, one specific loaf of bread, for example. And compare that to direct labor and direct materials. While not an easy task necessarily, you could more easily be able to say this loaf of bread that we produce came from this certain batch, and this certain batch we use this much direct flour, and it used this much time from the baker, right? So those things are easier to quantify as being directly tied into products, these two. And then overhead, again, is a whole litany of things. Another example would be like a factory supervisor salary, right? They're overseeing all of the direct labor, but they're not actually directly producing any products themselves. So again, it would be very unwieldy, if not impossible, to try and somehow take that factory supervisor salary and be able to allocate some portion of that salary directly to a finished product. But we still want to capture it as a part of the cost of the production because they are directly involved in that production process. It's just that we have to fit those costs away from direct labor because we can't easily tie those costs into one, specific product or specific batch of products, so on and so forth. And a whole bunch of examples of these. We're going to do a lot of that practice with figuring those things out. So don't worry too much about, having examples of these. That's something we're going to do with homework and in class exercises, maybe a little bit, in our lecture here. Oh, and let me just mention this. So notes question number 5 says, what are the 3 types of product costs? And boom, boom, boom. Direct labor, direct materials, manufacturing overhead. I'll just mention this now. Sometimes you'll see these truncated to be DL, DM, and MO or MOH when we're talking about, identifying these like on a report and stuff. So, okay, this just talks about in a little more detail like what I mentioned before. So period costs are expenses. They're not attached to the product. We don't capitalize them. I don't know if they use that terminology specifically here, but product costs we do capitalize, meaning we attach that to the product. It becomes an asset. These period costs, which we can identify and classify organize these into either selling or administrative costs if we'd like to. Those type of costs, again, are just put onto an income statement when they are incurred in a given accounting period and become expenses right away, versus product costs get capitalized as an asset and only get expensed once the product has been sold, later on. And these, here's some examples. Costs incurred to obtain customer orders. This is selling costs to deliver finished goods, advertising, shipping, so on and so forth. And then administrative costs, on the other hand, both of these are period costs, would be things like non-manufacturing, staff support, administrative functions, like I just mentioned before, accounting, could be IT department, data processing, HR, research and development. So kind of everything outside of the factory, is all this stuff. You can kind of think of the product cost as what happens in the factory. Okay, this one's a little busy, but it does do a good job of further breaking down this distinction with product and period costs. When it comes to the period costs, we just talked about sales and administrative, so expensed in the period incurred, non-manufacturing, so that's good there. So let's focus in on our product cost side. So again, these are manufacturing costs. These are like costs that happen in the factory, if you want to think of it that way, recorded as inventory when they are incurred, or the word I keep using is capitalized. But anyway, if you want to think of it, mostly they're being recorded as inventory specifically. And expensed when they're finally sold. So question number 6 in the notes says, what are the 3 inventory accounts for a manufacturing firm? And that's going to be direct materials, direct labor, and manufacturing overhead. So these 3 things here. And here's some examples, right? So raw materials, like we said, flour for bread, could be steel for a car, sugar for pop, soda, whatever. I'm not sure where this is produced necessarily. Maybe you guys use this terminology, but pop, it just means sodas. Not something I hear often here in Northern California, but that's what they're indicating there. And then there's direct labor. That's just, like I mentioned before, workers on the line, actually making the products, directly involved with the production. That's probably pretty easy to imagine. Someone actually doing the mixing, if it was a bakery, for example, as they're making the bread or something. And finally, there's manufacturing overhead. And you can further break down the overhead into 3 more categories. And I know that, there's a lot of categorizing going on. We'll practice with this quite a bit. But this one can be broken down because manufacturing overhead does really encompass a lot. Because it's kind of a catch-all for everything that doesn't fit in these categories. So you can have indirect materials, things like some kind of glue or WD-40, lubricant for factory machines. So these are supplies, materials that are used in the production process, but they're not, the flour and the sugar that goes into the actual process, right? It's kind of supporting materials. Then we have indirect labor. As I mentioned before, that's things like factory supervisors, could be janitors for the factory specifically, could be factory super guards, security guards. So anything that's involved with the factory and the production process that's outside of the direct labor, essentially. And finally, other factory costs. This could be all kinds of stuff: rent, insurance, utilities, property taxes, depreciation of factory machines. So anything else that's a cost, related to production, that just doesn't fall into the category of any of these other things. And they you can have rent expense for a factory. You're renting a factory, for example, factory building, and that would go under manufacturing overhead. If you're renting an office for the accounting department, then that would be a period cost. So they're both rent expense, but since this one's more involved with directly with the production process, we're going to record that as inventory. It's overhead. Whereas if we have rent expense associated with salaries with selling or administration of the business, then we would just expense those, right? So again, we'll practice with this, but that's the idea. Is the key thing to look for when you're trying to categorize these accurately is really, is it related to production directly? Is it a factory cost, or is it some administrative or sales related cost? And then finally on this slide, we kind of categorize direct materials and direct labor as the prime costs. These are the 2 things going into the production process. And then conversion costs are the overhead and the labor that converts those materials and labor into the final product. So a couple extra little or categorizations for you. Okay, so we'll move on to the next slide here, and we'll kind of dive into the specifics of some of examples of raw materials, direct materials, etc. And one thing I'll highlight is you'll see direct materials. Sometimes you'll see the raw materials. So there's some few instances in this class where things have more than one commonly used name. So you might see RM or raw materials or DM direct materials. Hopefully that won't be too tricky in any instance, but keep that in mind. And if you want a really solid definition of what we were just talking about, materials that could be physically and directly associated with manufacturing the finished product. So just some examples: tea leaves, spices, packaging, all direct materials. Direct labor, the work of factory employees that can be physically and directly associated with converting raw materials into finished goods. So like if you're working on a factory line, production line kind of thing. Oop, this one's going off I'm not sure what that's even trying to say up there. I guess they're just, that says manufacturing overhead. Sorry, that slide's a little funky. So manufacturing overhead for this tea company. It's just giving some examples of these things again. We kind of talked about this already, but indirect materials, labor, factory supervisor, wages, rent, and so the things to watch out for if you see factory versus admin office supervisor or admin office rent, this is, if it says factory, it's a product cost. And then also if you want to differentiate between wages, whether they're going to be overhead or direct labor, definitely look for things like, is it the supervisor? Because that'll be overhead versus, direct employees making the products will be direct labor, or like a janitor or something, some supporting individual. Yeah, we kind of talked about all this other stuff already, so let's move on. WD-40 again, yeah, cleaning supplies could be indirect materials, which is overhead again, so just more examples. The janitor, the security guard, those are overhead costs. We already kind of looked at that here, but just another slide showing that. Our prime costs of direct materials and labor, and then conversion costs to convert these materials and using the labor into final products. So just more classification. And then touching on how this kind of applies for service companies, because typically when we're talking about these concepts, we're looking at it from the perspective of a manufacturer. But some of these same concepts can apply to service companies, in addition to manufacturing companies, in that you could still take some of the organization ideas, I suppose, and sort of aggregate those in different ways, right? And if you're trying to, you're an accounting firm, for example, and you want to classify costs, that are related to a specific customer, a client, you could sort of organize those all in a certain way, and then you'd have, supporting sales and administrative costs separately. So anyway, just know that, again, these are flexible type of concepts and reports. We're going to really focus in on manufacturing in this kind of deal, but keep that in mind. Okay, so let's look at kind of the third section of our chapter here, and we're going to talk about product costs on the balance sheet and the income statement. So we talked about this in chapter 0. Merchandisers buy finished goods, sell finished goods, pretty simple. Manufacturers buy raw materials, and then they do a whole bunch of production to create a finished good that they then sell, right? That's the distinction there. And so when we look at a manufacturer, we've got some different inventory accounts that a merchandising company would not have, right? Merchandising company would just have, let me go back to that slide. Oh, geez, sorry. A merchandising company would just have merchandise inventory, essentially, right? I mean, they might have different types of merchandise inventory because they could have different products, obviously, but they would just have finished goods, basically, right? But with a manufacturer, we're going to classify these into 3 different steps. So that inventory can either be raw materials, like this is the flour and sugar and all that stuff, and then the goods in process or work in process. This term, this slide talks about. I'll mention that in a moment. I like to use the term WIP or work in process. Goods in process is fine, but this is kind of like when the bread is being mixed up and it's all the dough. It's dough at that point, and finally finished goods would be it's completely finished cooking and it's packaged to be ready to be sold. Then it's a finished good. And all 3 of these are different stages of inventory. So these are all assets. They're all inventory. They're just different stages of inventory, basically, that we want to keep track of as a manufacturer. And then again, the text uses the terms goods in process, same in work in process. Yeah, and so we'll use the word WIP mostly, work in process. I don't know, flows off the tongue better. It's more used in the real world, so that's what we're gonna try to use more often. So as we mentioned, inventory has these different categories. So if we were to compare that merchandiser versus the manufacturer, so on the merchandiser side, we just have that one, finished goods, merchandise inventory type account. And then on the manufacturer side, we've got those 3 categories, subcategories of inventory, basically. That's raw materials, work in process or goods in process. So this is WIP, and then finished goods. But in all other respects, as it mentions here, cash, receivables, all these other accounts that we've talked about, you learned about in financial accounting, those don't really differentiate, necessarily between the merchandiser and the manufacturer. It's just within inventory that you're really seeing a difference with these three categories and stages of the inventory versus everything that a merchandiser buys is finished goods. It's ready to be resold. That's on the balance sheet there, inventory asset side. On the income statement, and let me just back up real quick, just as an FYI, number 6 on our notes, what are the 3 inventory accounts? Maybe I mentioned that already, but it's these 3 here. And if you want to put goods in process, that's fine. You want to put work in process, that's even better, because that's what, as we mentioned, we're going to try and use that term mostly. Okay, sorry, back to the income statement now. So the only major difference on the income statement is really this idea of cost of goods purchased versus cost of goods manufactured. They mean the same thing, essentially, purchases versus cost manufactured. That really just comes down to how much did we pay, for the inventory that's finished goods from a merchandiser versus what was the cost specifically for the increase in finished goods for a manufacturer. So it's just really highlighting that fact that we're not purchasing inventory, we're manufacturing it, right? Okie dokie. So let's move on to the last quarter of our chapter slide deck. And in this section, we're going to talk about the flow of costs and reporting manufacturing costs. So our previous instructor who did a lot of work in accounting 4 and designing this class's materials retired in the summer of 2026, Beth Dunn. She included kind of a picture of the plant that her company has that is a construction company. And so they built houses. They still build houses, I believe. And so she was just trying to kind of show you what these costs sort of look like in the real world, from a product cost perspective. Maybe this is like the raw materials, out here. Maybe there's a factory here where they're doing stuff and converting that into some sort of intermediary work in process. And then a finished house could be more of a final finished good. Okay, so this slide here kind of has a lot going on, so let's take it slow. What we're trying to show here is the flow of these costs from that raw material beginning point all the way to the finished goods ending point. And let's just kind of take it from the left side over here. So when we buy raw materials, usually we have some beginning balance, right? So we carry over, unless this is the very first month of operations or whatever. Typically there's some sort of, let's use the bakery example again. You've got some flour left over, on the shelf that you didn't use it all up at the last day of the last accounting period, for example. So you're starting with something. Then we're probably going to buy some more if we need some more. So we're going to add in purchases, and that gives us a total of raw materials. And then there's 2 places that can either go, right, once we're at that point. So raw materials at the end of the period could either be still sitting on the shelf, some portion of those raw materials, but then some other portion of that, you could split that out into how much went into production during that accounting period. And I'll just say month as an example to make it easy. How much went into production in the month? Okay, and then so that's raw materials. You buy some, or maybe you start with some, you buy some more, and then it either is still sitting there at the end of the month or it's now in production, right? And then the WIP part of the equation here brings in those 3 components of labor, overhead, and raw materials. And again, part of that raw materials comes from that first inventory account of raw materials. So this is the stuff that's in process, and we could combine all these together. And then again, we kind of separate that out from here into, okay, at the end of the month, there's, there could still be some dough that's in the I forget what they call it, but the proofer, I think they call it. It's like a thing that makes the dough ready to be worked with. Or, it could be just whatever product it is that you're making that's just, in the process of being complete, but it's not yet a finished good, right? So we'll end up with some ending inventory. That'll become our beginning inventory, for the next cycle, just as with all these things. And one thing to highlight here, I think maybe it's obvious, but I'll just say it, the way that products are being created is not necessarily completely aligned with how our accounting periods are being, analyzed, right? So just because the month, maybe we're doing accounting information at the end of every month, and so we're trying to say, okay, at the end of the month, we've got X amount of inventory, for example. The production cycle is just always happening. And so that's why we would have some work in process and raw materials and stuff at the end of the month, because it's not like the factory guys, people who are out producing these products are going to be looking and saying, oh, we have to finish every project before, January 31st, because the accountants have that as the end of the month and they need us to have 0 work in process at the end of the month, right? That's not how it works. Instead, production is just always going, and we as the accountants are basically just reporting what state our inventory is in at the end of that period based on, is it raw material? Is it a work in process? Okay, and so again, with good work in process, then we either have 2 places it can end up. It can either be ending inventory still, half not finished but still there, or the stuff that is finished then goes into cost of goods manufactured, and this is our finished goods. So that's the addition here. We had again probably some carryover finished goods from the prior month that just hadn't been sold yet. And then we're adding more into that with, our work in process that we finished. So that becomes the cost of goods manufactured. So you add you add the beginning inventory plus the additions that we finished during the month. And then there's only 2 places that can go, either to ending inventory that's going to be, sitting on a shelf or in a warehouse or something. Or if we sell that inventory, then it goes as an expense onto our income statement for cost of goods sold. So as we talked about in chapter 0, this whole concept of calculating cost of goods sold with beginning inventory plus purchases minus ending inventory equals cost of goods sold, that is very kind of applicable here as especially as we're thinking about things from a perspective of it's either here or it's gone on, and it's either moved into a new step of the process here from raw materials to WIP to finished goods. And eventually it's the same concept that the finished goods is either here and it's an asset still, or it's gone and it's cost of goods sold. So we'll play around with this a little bit too. I know it's kind of busy and there's sort of a lot going on, but just try to pull back from the detailed view and realize what we're talking about is just the flow of costs from one inventory type to another, one asset type, begin with raw materials, then WIP, then finished goods. And finally, after it moves through this whole 3-step process, is it still here or did it sell? And that's where we get finished goods, ending inventory, or COGS. A way to represent this and track it in terms of a reporting mechanism is the manufacturing statement. And so the manufacturing statement here, as it mentions here, summarizes the types and amounts of costs incurred in a company's manufacturing process. And so we could calculate cost of good manufactured by taking our direct materials used, direct labor, factory overhead, so those 3 costs of production there. And then that's our total manufacturing costs. And then we basically do this whole beginning finished goods inventory plus cost of goods manufactured minus the ending work in process equals costs of goods manufactured. So this is the beginning finished goods. This would be what is the new finished goods during the month that we completed. And then with both of those together, we could look at the ending finished goods that's still there, or sorry, for this one, WIP, if we're trying to see what went into cost of goods manufactured. So then that becomes this component, right? It's either still in WIP or it's finished. And we can kind of extend this concept, further as we go into the idea of beginning finished goods inventory plus cost of goods manufactured minus finished goods inventory equals cost of goods sold. So we're kind of doing that same cost of goods sold calculation we practiced in chapter 0. We could sort of do that at each one of these 3 steps, as far as beginning plus additions minus ending equals what's here versus what's gone. And when it's gone in the first step of raw material, that just means it becomes part of WIP. When it's gone in the second stage, that just means it becomes part of finished goods. And then when it's finally gone as a finished good, then it means it's actually sold to the customer, and it becomes a cost of goods sold expense. All right, let's look at a manufacturing statement. So this is the report I was mentioning earlier that we could use to basically figure out cost of goods manufactured, and that's this figure here basically. And another way to say that, the cost of goods manufactured, then, if you want to remember it, is the new finished goods that was produced in this year. This is for the year ending December 31st, 2008. Okay, so kind of just what we were looking at there, you take your materials, labor, overhead, add those all together. You add your beginning WIP. This is kind of our new WIP, beginning WIP. That becomes total cost of WIP, goods in process, or I'm saying WIP every time in place of goods in process, just because that's the work in process term we're going to use more often. So hopefully that doesn't trip anybody up. So again, we do all this work to basically say, okay, of all the WIP that we produced in the month and we had at the beginning, we go look at what's left over at the end of the month, and we say, oh, okay, there's still $7,500 worth of work in process that's still in process at the end of the month. So therefore, everything else has then been completed. It's no longer work in process, and instead it's moved on to be a component of finished goods. And behind the scenes on, say, direct materials used in production, there's a further sub-calculation. Again, that would be basically this part. And we'll practice with this with some exercises, but we're just showing that to get this figure, you have to go through the steps of beginning raw materials plus more raw materials minus what's left in raw materials. That becomes the cost of the materials used in production. The labor part, just you don't have to do a sub calculation because that's just all the direct labor costs incurred. And then overhead is just a whole long list of random stuff that falls in the overhead category, right? It's different things: indirect labor, factory supervision, factory supplies used, depreciation on factory equipment, so kind of that catch-all. Beginning WIP, again, that's just carried over from the prior period. We usually start the month off, with something that's not. We don't clear out the whole manufacturing process every month at the very end of the month and say, okay, now we're going to have a whole new shipment of inventory arrive on, day 1 of the next month, right? This is always just a continuous cycle of production. Ending WIP, what do we have? Unfinished goods. So again, that could, if it's a bakery, that's the dough that's sitting out, in the mixer or something at the end of the accounting period. That's just still in work in process. And then onto the next slide, we're just kind of showing a calculation of the cost of goods sold for a manufacturer. And what we're showing here is, here's sales, here's COGS. In order to calculate COGS, I'm going to go back here, we need to do this part, right? Because that's what we're trying to get down to, is this figure. So the way that we could show that on an income statement, go here, is to list out those components of the calculation where we have beginning finished goods inventory plus the additions or cost of goods manufactured during the period, during the year in this instance, less what's still finished goods inventory that's sitting on the shelf somewhere. We still own it, hasn't been sold yet. So we take that out. So the only other place it could go, that would be that it was sold, and it becomes cost of goods sold at that point, right? So we could take sales minus that number, cost of goods sold, equals gross profit. And then we start to show down here, like other costs like utilities and administrative costs, etc. Those then all go below gross profit. Cool. Okay, well that pretty much takes us to the end of the chapter. I forgot to look back at my notes here. Make sure I answered everything. And one note here that I guess isn't exactly covered very well in this chapter 1 lecture slides is number 7. It asks for all costs are either fixed or variable. Describe each from this perspective. So I'll just tell you at this point about how that works. So fixed costs are things, and let's look at an example actually from here, anyway, from this slide. Fixed costs are going to be things that don't necessarily change when production changes, right? So fixed means fixed. So fixed costs would be things like, let's say, property taxes on the building. Those property taxes are going to cost whatever they cost. The payment is going to be what it is, regardless of whether the company produces 1 million loaves of bread or it produces 500, right? Property taxes are just fixed. They are what they are. But when we think about something like direct labor of the wages or direct materials of the flour and the sugar going into that bread and all the other stuff, the amount of those products used will directly correlate with how much we produce. So if you produce 1 million loaves of bread versus 500, when you use 1 million, that direct materials used is going to be much higher than when you only produce 500. And so if those costs change based on production, that's what we would call a variable cost. And then again, compared to a fixed cost, which is something like property taxes or insurance, where those costs don't really have anything to do with the number of units of a given product that we produce. So we call those fixed, right? They're fixed, they don't change. Variable, they do vary depending on how much you produce. And then finally, the last question, number 8, outline the flow of manufacturing costs. I think the best place to see that really is probably this slide. And you don't have to write this whole slide down or anything for notes number 8. But the idea here is that we start with raw materials. That goes and turns into WIP or work in process. That then goes into finished goods eventually. And then eventually that finished goods goes into cost of goods sold once it is sold. So again, the flow of manufacturing costs for the notes number 8 would be raw materials to goods in process or work in process, to finished goods, and then finally to cost of goods sold. Okay, cool. And that looks like it hits all the questions from our notes, and we made it through to the part of the end of the chapter lecture here. And so what we're going to do in our in-class exercises and our homework problems, etc., just conceptually high level, is that we're going to work on classifying costs, as either product costs or period costs. If they're manufacturing overhead, we're going to try to identify whether they are indirect materials, indirect labor, or other types of overhead. And then we're going to work on basically doing this whole sort of calculation, kind of this, type of thing. And also really what we're going to be doing is this whole process to eventually get us to be able to calculate cost of goods sold and also calculate, what are the ending balances in raw materials, WIP, and finished goods, so on and so forth. So I will see you there in those videos, and I'll be with you in class working on some of the in-class exercises that we're going to do that will accomplish those goals. And I think after we really work on this and you get your hands in it, it's going to make a lot more sense. But hopefully you enjoyed the lecture and it was helpful to set the stage for us to understand how we categorize and start to classify costs for a manufacturer. So thanks everyone. I will see you in the next video, and hope you're all having a nice day. Alrighty, bye.